Hello there. Welcome back to Grade 10 Economics. Today, I want to look at a question from a paper, two question paper, and we're going to look at a question on taxes. So, the question that we have there reads a differentiate between a direct and indirect tax. And your question has got 8 marks, and we are saying that we're supposed to raise our 4 points and then each one with 2 marks to give our 8 marks. So this is what we have. So we can start by understanding exactly what we mean by a direct taxes, but we know that a direct taxes are taxes that are imposed upon an individual, or they can be imposed on property. Which is different from indirect tax, whereby indirect tax we are saying is tax that is being imposed or levied on a transaction. So also in the terms of collection of those taxes also is different between direct and indirect, and we know that under under direct taxes, the tax authority is the one responsible for collecting that tax, and that is SARS in the context of South Africa. And then we have indirect tax, which is being obviously being collected by uh, a manufacturer, or it can be a retailer that is collecting on behalf of SARS. So this is what we have between direct and indirect tax. So our question is asking us to come up with differences, as it is saying differentiate between direct and indirect tax. So these are the differences that we have here. So you see that under direct tax, tax is levied on wealth. That is our, for example, we have got income tax. So that is what we have under direct tax. Under direct tax, then under indirect tax, we see that indirect taxes are levied on goods and services. So this is now the difference that we have between direct and indirect. Going the second difference, we are told that the second difference is that direct tax is paid directly to SARS. That is direct tax. And remember, when it's income tax, for example, it's for individuals. We see that they are charged pay as you earn, which is pay, which is charged directly on their income that they are earning. That is the our salaries and wages, and then it's collected directly by SARS. So, but if you go to indirect tax now, we see that indirect tax is paid to an entity or manufacturer by the consumers by buying goods and services. So first of all, the retailers, or they collect the tax, and then they submit the tax to the tax authority, that is to SARS. So that's the difference that we have. Then that's what we have on indirect. So going on to the next difference, I would say that under direct tax, income tax for individuals are based on a scale, and income tax for businesses are levied at a fixed rate. So this is how it is. Direct taxes are charged. That is on individuals is based on a scale. And then I will see that our other businesses now, which is the carbon tax, is going to be a fixed rate. But if you go to our indirect tax, you see that our rate is just fixed. So it becomes a difference that we can also try to deduce. So tax is fixed. And then we go to the next point, which is saying under direct tax, there is no possibility of leakages uh, on revenue collection as it is collected directly from the taxpayer. We are saying the possibility that there can be leakages in terms of revenue collection is limited in terms of direct tax, because it's collected directly by the tax authority. But in the other indirect tax, we'd see that there is a possibility, because this tax member is going to change hands. The retailer is going to collect first, and then it submits to the tax authority, that is to SARS. So there might be a possibility that along the way there might be some leakages that might take place. So this is what we have for the last difference that we have. So remember, we now have our four differences that we have tried to come up with differences between direct and indirect tax. So going to the second part, let's just try to see what we have in terms of the second part of the question. Uh, the second part of our question, we have got a question that is asking us on the production possibility curve. And we know that a production possibility curve shows a combination of two goods that can be produced in an economy using usually a fixed amount of resources or inputs. So our question there explains that asks us to say, describe the external factors that affect the positioning of a production possibility curve. So external factors that affect the positioning of a production possibility curve. We have those external factors being listed there. Then our question has got also 8 marks, and we are seeing that it requires us to raise also 4 points, each with two marks. So obviously our total marks becomes also 8. So this is what we have. So one of the external factors that affect sustainable production positive is economic growth. So remember, if we look at the production possibility curve, this is a typical PPC, which is the production possibility curve. So if this position changes, that's how this question is asking us that if the positioning or production possibility curve changes, it means this production possibility curve is either going to shift inwards was going to shift outwards. So this what can cause that are those external factors that we have listed there. So for example, if we have economic growth, remember what economic growth means. Economic growth is the increase in the monetary value of goods and services that are being produced in an economy. So if we see that the production of goods and services is increasing, obviously we are saying the production possibility curve is going to shift outward like this, and we are going to have a new production possibility curve. So this becomes our new production possibility curve, which is our PPC is our PPC1. If this one is PP0, this one becomes our PPC1. So we have an outward shift, which means we have more production of goods and services being represented by that economic growth. But if we are seeing economic growth going down, in other words, we are saying total monetary value of goods and services that are being produced we are having a decrease. It means obviously we are going to have a shift inwards of that PPC. So this is what we have called technological advances. So when we've got technological advances, obviously technology makes a production of goods and services efficient. So obviously we are going to have also more production if there are technological advances. So we are also going to notice an outward shift of the production possibility curve. Then availability of resources. If resources are depleting, or we have got a reduction of resources in the production of those two typical goods that we are producing under the production possibility curve, it means also the PPC is going to shift inwards, indicating that there is a decrease in the total goods that are being produced. So the opposite is true. If we have got more availability of resources, we are going to have more production of goods and services, and the PPC will shift outwards. So if you look at the next point now, we have got level of technology used within the businesses. So level of technology, we are saying which technology is being used. If you have got advanced technology, so this one becomes a sort of a repetition of the point that we are having here. So because it's also explaining in terms of the advancement of technology. If we have got more modified technology, it means we've got also more advanced technology. So if you go to the next one, it is demand for a specific good. So if demand for a specific good increases, obviously we are saying the businesses that are producing that goods are going to earn more revenue, because they're going to reinvest that revenue in terms of increasing profit margins, and then they're going to produce more goods and services, and you're going to see an outward shift of the PPC also. So if the demand also goes down, is the opposite becomes true. That is, we are going to see a reduction of total amount of value of goods and services that are being produced in the country, and then we are going to see an inward shift of the PPC. Then lastly, we've got profitability of a specific product. Profitability of a specific product, we are saying if you go to our PPC, you see that we have got a machinery on our typical PPC that we have, and then we've got clothing on the horizontal axis. So we are saying maybe the one that has got more profitability is going to be clothing, which is clothing is the one that is going to increase its production, and we are going to have an outward shift of clothing only. So it means here the maximum that can be produced by machinery is not going to change; it will remain fixed. So we are going to notice that we have a shift that will this position becomes fixed, because we are saying on the machinery it's not changing, so it will be like this, and then it will show an increase in machinery only. So this is the typical shift that will take place. So it will shift only on the product that has increased profitability. This is what we have in terms of a shift in profitability. So we go back again, try to see in terms of explanation that we have on demand for a specific product. Also, we are also going to have a similar shift that we have here, because it's a change that is taking place on a specific product, just like on profitability is taking place on a specific product. So we are saying the change that is going to take place will be on the specific product that is having a change in terms of if it's profitability or if it's demand there. If it's an increase in demand, it also shifts outwards, and we are seeing that if it's a demand of clothing, it will decreases this. But machinery is not going to change in terms of the maximum that can be produced for machinery, because the profitability hasn't changed, so its production also is not going to change. So this is what we have in terms of the explanation on the external factors that can affect the positioning of a production possibility case. That is our PPC. This is what we guys are to this video. Let's subscribe and share. Let's share the link to our colleagues who are doing grade 10 economics. As for this video, I'm signing out. Let's meet again in the next video.